Welcome back to Dreamlit Equity Research. Today we're looking at Nu Holdings NYSE Nu, a company born out of a bad day at the bank. In 2012, its founder, David Velez, walked into a Sao Paulo branch, handed over 6 forms of ID, waited half an hour, and was told he was being watched by security. That humiliation became the seed of a bank built for the 650 million adults across Latin America who'd never been treated as customers worth serving. Today, Nu has more than 135 million of them, over half of Brazil's entire working-age population. Revenue is growing near 40 to 50% a year, and its efficiency ratio, how much it costs to run the bank relative to revenue, sits around 17.6%, the lowest of any major bank in the world. And yet the stock trades roughly a third below its 52-week high, after 2 analysts' downgrades flagged credit quality concerns and a CFO departure. Is this a compounding fintech story on sale, or is the market seeing a credit problem the headline numbers haven't caught up to yet? Over the next 20 minutes, we'll walk through the business, the numbers, the risks, and where the stock could go from here. This is a research note, not financial advice. Do your own diligence. Let's begin. Quick disclaimer, because it matters. This is educational content, not financial, legal, or tax advice. I'm not a licensed advisor, and I'm not registered with the SEC or SEBI. Everything here reflects my own opinions, which can and do change as new data comes in. Investing carries real risk, including loss of principal. Do your own research and consult a professional before acting on anything. All data comes from public filings, earnings releases, and publicly available research used under fair use for commentary and analysis. With that said, let's get into it. Here's the dashboard and a few numbers worth sitting with. Revenue hit $5.3 billion in the first quarter of 2026, up 57% year over year on a currency-neutral basis. The first time Nu has crossed $5 billion in a single quarter. Net income was $871 million, and return on equity annualized to 29%, which is well above what even JP Morgan, widely seen as the best-run major U.S. bank, typically generates. Then there's the efficiency ratio, 17.6%, meaning Nu spends under 18 cents to generate every dollar of revenue. Traditional Brazilian banks run at 45 to 60%. That gap is structural. It comes from having 0 branches and AI-driven service across 135 million customers. The metric to actually watch, though, is RPAC, average revenue per customer, which has climbed from under $4 a month a few years ago to around $16 today, against $45 to $80 at legacy banks. That gap is most of the investment case. Market cap sits near $58 billion, with the stock around $12, well off its $19 high. Strong fundamentals, a battered stock price, both true at once. That tension is what today's video is about. The origin story is simple. In 2013, Velez, a Colombian who'd worked at Sequoia in San Francisco, moved to Brazil and got treated like a suspect for trying to open a bank account. At the time, 5 banks controlled roughly 80% of Brazilian banking, charging steep fees to a population with no real alternative. Velez, along with Christina Junqueira and Edward Weibel, launched a no-fee purple credit card managed entirely through an app. The waitlist passed 1 million people within weeks. The incumbents called it a toy. In 2018, Berkshire Hathaway invested $500 million. Buffett compared it to the early Amazon, a credibility signal that mattered as much as the capital. Nu listed on the NYSE in late 2021 at a $45 billion valuation. Right as tech valuations globally began falling, so many investors' first experience with the stock was watching it drop. But the underlying business kept compounding through that. From roughly 6 million customers in 2016 to 135 million today, and revenue growing from under $2 billion to nearly $16 billion. 3 things came out of that history. No branches to maintain, ever, a widening revenue per customer flywheel as products get added over time, and the Berkshire stamp of legitimacy that opened doors with global institutional investors. Nu calls it strategy lifecycle banking. Get a customer in cheaply, then deepen the relationship over time across credit, spending, saving, investing, and insurance, all inside one app. It starts with the credit card. No annual fee, fully digital, which alone now reaches roughly 60% of Brazilian adults. From there, Nu layers in personal loans, including payroll-deducted loans with structurally lower default risk, then a high-yield savings account that funds its lending at a lower cost than competitors relying on wholesale markets, and finally investing in insurance products that are still early but represent the biggest untapped opportunity. The logic is straightforward. A customer generating $16 a month today could plausibly generate $40 to $50 a month once fully cross-sold. And that gap, more than new customer growth, is where the next few years of revenue is expected to come from. Against legacy banks with high fees, long queues, and poor customer satisfaction scores, Nu's transparency-first model has been consistently winning the relationship, not just the transaction. The financial trajectory here is the core of the thesis. Revenue went from $1.7 billion in 2021 to $15.8 billion in 2025, roughly 9 times in 4 years. And growth hasn't meaningfully decelerated as the base has grown, which is unusual. Net income tells a similar story. Nu was losing money as recently as 2022, turned profitable in 2023, and generated $2.9 billion in 2025. Return on equity has climbed from negative to around 30%, and the efficiency ratio has fallen from the mid-50s to that record 17.6% this past quarter. Each dollar of revenue costing less to generate as the company scales, which is the opposite of how most banks work. One note of caution. Q1 2026 earnings per share came in about 10% below consensus, and combined with the CFO's departure, that's a meaningful part of why the stock has sold off even as revenue keeps accelerating. Worth keeping in view as we go. For markets, for different stages, Brazil is mature, around 100 million customers and over half the adult population. So the growth story there has shifted from acquiring new customers to deepening existing ones. Mexico is the one to watch. It just reached break-even in Q1 2026, the same inflection point Brazil hit back in 2019, right before it scaled from a few million customers to nearly 100 million over 5 years. If Mexico follows even a rough version of that path, it could add several $billion of annual revenue by the end of the decade, though that's an extrapolation, not a guarantee, and we'll get to the risks. Colombia is earlier still, in a brand-building phase rather than a monetization one, which has been Nu's playbook everywhere. Get the customer first, cross-sell later. In the U.S. is optionality. A conditional bank charter is in hand. A 2027 launch is targeted, but Nu has zero brand presence there and faces incumbents who are already digitally sophisticated. The Brazil and Mexico thesis doesn't need the U.S. to work. It's upside, not the base case. AI shows up in 3 places that actually matter for the numbers. First, underwriting. Credit decisions across a $37 billion loan book are powered by models trained on 13 years of behavioral data from 135 million customers, which is genuinely hard for anyone to replicate. Second, customer service. Generative AI handles the large majority of support volume across 3 languages, which is a big part of why the cost base is so low. Third, personalization. Offers for loans, savings, and investments are tailored per customer rather than broadcast to everyone, and that's a meaningful driver of the RPAC growth we've been discussing. On the horizon, a customer-facing financial assistant, Nu AI, that could put Nu in direct competition with paid advisory services and Brazil's open finance rules, which let Nu see competitors' account data with consent, turning what's usually a defensive data advantage into something closer to an acquisition tool. 2 different competitive fronts. Against the legacy giants, Itaú and Bradesco, the gap is structural. They can't close their branch networks without hurting near-term earnings, so their efficiency ratios are stuck in the 45 to 60% range while Nu sits at 17.6%. That gap isn't closing anytime soon. Against Mercado Pago, the financial arm of Mercado Libre, the overlap is real, but the relationship isn't purely competitive. Mercado Pago is a payments and lending platform, not a full bank, so a customer can easily use both. Against global neobanks like Revolut, Nu's edge is a decade-plus head start in Latin American data and regulatory relationships that can't be built overnight. And against SoFi in the U.S., Nu simply runs a better set of numbers, higher growth, higher ROE, better efficiency, while trading a lower multiple, largely because the market applies a risk premium to Latin America that it doesn't apply to a U.S.-domiciled company. Whether that premium is fully justified is really the question this whole analysis is trying to answer. Two risks here are serious and live right now. So let's be direct. First, Brazil credit quality. Loan loss provisions are up sharply. Brazil's benchmark interest rate is elevated near 15%, and that combination raises defaults on unsecured lending. Bank of America downgraded the stock specifically citing this, with a $10 price target. The number to track every quarter is the 90-plus day delinquency ratio. Any sustained move higher is the single biggest threat to the thesis. Second, leadership. The CFO who built trust with institutional investors over years of earnings calls is leaving in July, replaced by a Visa veteran who hasn't yet had the chance to build that same track record. That departure, landing right as credit concerns are already live, is a big part of why the stock has been under pressure despite accelerating revenue. Beyond those two, there's real but more moderate risk from currency swings. Nu reports in dollars but earns mostly in Brazilian reais, for valuation compressing if growth slows, from tougher competition as Nu pushes into Mexico and Colombia, and from the operational lift of trying to launch in the U.S. while still building out those newer markets. None of these are dismissed lightly. There's simply lower probability than the credit and leadership questions. Three things need to hold together for this thesis to work. One, that financial inclusion in Latin America is a structural, multi-decade trend rather than a temporary boom, which looks solid given how much of the region remains underbanked, though a prolonged Brazilian credit crunch could still hurt the stock for a year or two even if the long-term trend survives. Two, that Mexico actually replicates Brazil's growth curve rather than settling as a smaller, subscale market. The break-even milestone is a genuine positive signal, but incumbent banks and Mercado Pago are entrenched there too, so this isn't guaranteed. Three, that the AI-driven cost advantage keeps widening rather than converging, which has held true for over a decade, but could be tested if regulators require more human oversight of AI credit decisions, or if a credit cycle behaves in ways the models haven't seen before. If all three hold, this is a compounding machine. If even one breaks down for an extended period, the valuation gets harder to defend. With the stock around $12 and the next earnings report due August 18th, here's how the scenarios break down. In the bear case, Brazilian credit losses accelerate and the CFO transition goes badly. The stock could see $7 to $9, with the multiple compressing toward how legacy banks are valued. In the base case, where Nu delivers roughly on consensus, the new CFO communicates well, and credit quality stabilizes. A reasonable 12-month target is $15 to $19. And in the bull case, where Mexico accelerates faster than expected and AI-driven products meaningfully lift RPAC, $22 to $28 is plausible. For context, the 21 analysts covering the stock lean heavily toward buy, with an average target near $18.50. But that consensus spans from $10 at Bank of America to $22 at the high end, which tells you this is a genuinely contested call, not a settled one. At roughly 14 to 18 times forward earnings, Nu trades at a discount to some interesting peers. Mercado Libre, a comparable Latin American growth story, trades over double that multiple despite a similar return on equity. It too, the legacy Brazilian bank, trades far cheaper, around 8 times, but grows a fraction as fast. And SoFi in the U.S. actually trades at a higher multiple than Nu despite lower growth and a much lower return on equity, largely because investors are more comfortable with a U.S.-domiciled company. The discount on Nu really comes down to two things: a Latin America risk premium and the current credit quality concerns. If both ease, there's a reasonable case for the multiple to re-rate higher. If credit quality gets worse instead, the market may simply start pricing Nu as an emerging market bank rather than a growth fintech, which is the real risk behind that Bank of America downgrade. If you're tracking the stock going forward, a handful of things matter more than the rest. The big one is Q2 earnings on August 18th. Watch whether revenue growth holds up, whether RPAC keeps climbing, and above all, whether that delinquency ratio is stable or rising. Second, keep an eye on Mexico. Is its revenue per customer moving up quarter over quarter the way Brazil's did at the same stage? Third, watch how the new CFO handles the earnings call. Communication quality matters a lot for investor confidence right now. And fourth, keep half an eye on the AI product rollouts and the $1 billion buyback. Steady buyback execution is a reasonable signal that management believes the stock is undervalued at current levels. Everything else in the filings is useful detail, but these are the four things that would actually change the thesis. So, the whole thing in a few sentences. Nu is the most efficient digital bank in the world, with 135 million customers and a revenue per customer flywheel that still has a lot of room to run. And Mexico looks to be at the same inflection point Brazil hit right before its own decade of growth. What we like: accelerating revenue, a record efficiency ratio, strong returns on equity, and a buyback that signals management confidence. What worries us? Real credit deterioration in Brazil, a CFO departure at a sensitive moment, and a recent earnings miss that gave the bears real ammunition. At around $12, the stock sits between the bear case near $8 and the base case near $17. Meaningful upside if the base case plays out, real downside if Brazil's credit cycle turns out worse than currently provisioned for. Let's close it out. Nu built a bank most people said couldn't work. No branches, no legacy infrastructure, and scaled it to 135 million customers with the best efficiency ratio in global banking. The core opportunity now isn't acquiring new customers. It's deepening the ones it already has, as revenue per customer keeps climbing toward what legacy banks already charge. Mexico is the next chapter to watch. If it follows Brazil's path, this becomes a materially bigger company by the end of the decade. But the bear case is real, not a footnote. Brazilian credit quality is genuinely under pressure, and the CFO who built investor trust is leaving at a difficult moment. If you're considering this stock, you need an actual view on Brazil's credit cycle over the next year or two. Without one, you don't have a complete thesis. At current levels, this looks like a name sitting between a real risk and a real opportunity, which is exactly why it's worth understanding properly rather than taking anyone's word for it, mine included. Do your own research, and thanks for spending the time with Dreamlit Equity Research. See you in the next one.